Hello, everyone, and welcome to our August webinar. This webinar is based on the basics of financial planning. We are very glad that you've all joined us here today during your lunchtime. I do want to say up front that we want to make this as impactful as possible. People that are here are getting out of it what they want. So if you have any questions along the way, please don't hesitate to put questions in there. There are no silly questions. We'll be monitoring that as we go. This webinar is going to be recorded. So if you have to leave halfway through, if you have a meeting, something like that, this will be sent out after. And I'm Andrew McGill. I'm a wealth advisor here at 12 Points, and I'm also here joined by Carolyn. I can let her say hello.
Hi, I'm Carolyn. I'm a financial planner here at 12 Points.
And with that, we're gonna dive in and just we're gonna talk about why financial planning matters.
Oops. Okay.
No worries at all. So, really, financial planning, it's not really about trying to become rich, become perfect with money. Really, it's about getting organized, reducing stress, trying to lower the amount of financial uncertainty you have. Everyone comes at financial planning from a different angle. Some people come from a background of maybe like their family never talked about finances. Maybe they were always looking at numbers and things like that. So we're here to kind of meet everyone where they're at. We're going to talk about some different topics here today and ultimately just kind of give you some nuggets of information that we hope that you can take forward and give you a bit of less financial stress. So with that, we'll talk about what our agenda is for the meeting and for our webinar. So number one, we're going to talk through cash flow and savings. We're going to go to credit and debt management, basics of investing, retirement planning, protecting your family and financial security, and tax planning. So we got a lot to go through here today, and we're going to look to be moving through this efficiently. Again, if you have any questions, please let us know. And then if you do want to dive in any of these areas deeper, we'll put our emails after. Happy to do so. But for today, we're talking to so many different people. We're only going to go so deep into specific topics unless there's questions that come up. So with that, we will go to the next
Start
here.
with cash flow and savings. And we like to call it cash flow and savings, other than budgeting. No one likes the budgeting word. We hate the budgeting word. Budgeting is always associated with strict, no fun, save, watch your money, and that's not always the point of managing your cash flow or budgeting. So we do want to be aware of our income and expenses, and we want to know where our money's coming from and where it's going, but it doesn't have to be strict. If we put a classic 50-30-20 rule in place with our income, then we can have some wants in there and some fun. So the 50-30-20 rules, that is based off of your net take-home pay. So you've got your gross pay, you make X amount per year, but then you've got all the taxes, all the deductions coming out. What is hitting your checking account? That's what you want to be using every month to base off this 50-30-20. We like to say about 50% is needs, that's housing, groceries, utilities, the basic needs. And then we always say at least 20%, goal of at least 20% towards savings, whether that's a traditional savings account and maybe you're saving for a specific goal, or maybe this is saving in your retirement accounts, whatever that may be, at least 20% of your net take-home pay as savings. And then that leaves hopefully around maybe 30% for your wants. It doesn't have to be super strict, of no wants, no fun. Of course, you might not line up exactly 50-30-20. This is just a guideline, but it's a good baseline to start if you've never looked at your income and expenses this way. Start looking at, what are my needs versus my wants, as the first exercise of this. And it's about being intentional about where your money is going and being aware of it. It's not so much about restriction. Anything to add there, Andrew?
Yeah, no, I think it's to your point. It's again being intentional, understanding, keeping an eye on some of these things, keeping an eye on looking at what your bank statements are. Again, everyone's month seems to be can be different from month to month. Maybe you're going to a lot of weddings during the summer, or maybe during the winter there's gifts that you have. But I think it's really important to just kind of keep an eye on what are you spending your money on. I think that's half the battle because if you have nothing to really benchmark against, it's hard to make progress. So that's just the only thing I wanted to add there.
Hmm.
Speaking of what Carolina just talked about with the 20% savings, we think first, it's so important to be saving up in that emergency fund for the what ifs that happen in life. We often don't say it's not if, it's when that car goes out, when you need to pay some sort of bill, when you're like in maybe in professionally you want to get some sort of designation, you're like, oh my gosh, but this is going to cost me this amount of money to get that. Um, some a lot of times we recommend saving about 3 to 6 months of expenses, depending on if it's a single income that's coming in, saving 6 months. If there's two incomes, looking at 3 months, because they just combine that savings and combine those two incomes coming in. A lot of people, I remember having the question once asked to me there, someone said, I don't have an emergency fund set up, but I have these student loans I want to get rid of. I have about 10,000 left in my student loans. I got 10,000 in a savings account. What should I do? Can I pay down my student loans? And what I said is let's keep building up that emergency fund more. In their case, their interest rates weren't crazy, but I recommend continuing to build up the emergency fund because what can happen is you all of a sudden wipe out your student loans, you go down to having no savings. The next day your car breaks down, you have to buy a new car. And then all of a sudden, maybe it's $10,000 down you got to put down, and maybe you put that on a credit card or you get some sort of loan. You've now just moved your debt from one bucket to the next. And that's all because you didn't build up that emergency fund. Now, this is much easier said than done. We are not here to say, don't put money in your 401k, just put in the emergency fund. There's absolutely a balance of all of this. Okay. And what we think is so important with savings is creating that automated savings. A lot of people, when they think of automated savings, they think of a 401k, and that's why 401ks are so great. You can do automation outside of your 401k, where you can actually set up an automation to go right from your checking account, right from your paycheck to go right into a bank account or into a savings account and a high yield savings account. You can do that. Or you can direct the money to go every month from your checking over to savings. So you don't only have to automate just your 401k. There's other places that you can do that to cover that total 20% savings that Carolyn spoke about. And then the other piece is, as of in the last 2 years, the rates have come down a little bit, but there's still opportunity out there to find some high yield savings accounts that don't have that have strong interest rates on them. Some are around 3.5, 4 right now. There's some options out there. So when we say save into emergency fund, we're not just saying save into your checking account. Find a place that's safe. Find a place that has a little bit of we would call yield or just interest that would be generated from you. So that's what we would call a saving smart. So with that, Carolina, if you have anything to add there, we can keep rolling.
Just an emphasis on the automation. So easy and you don't even think about it. Moving on to credit and debt management. So debt management, not necessarily all debt is bad. Mortgage debt that helps you, land a home for your family. Education, if you're pursuing, higher education and this is going to excel your income and your career. And there's not always bad debt. When we talk about bad debt, that's usually high interest debt. And so it's expensive to borrow this money. Credit cards, number one, the interest rate, if you look at your credit cards, usually in the high 20s, 28% interest that they're going to charge you. I think credit cards get you when they put in the big font, 0% APY for the first 6 months or whatever it is. But look at the fine print and how much is that interest really going to be when you aren't thinking about it in 2 years and you start spending on your credit card. So that high interest debt, that's what we would say is bad debt. So developing healthy borrowing habits and only borrowing what you need, paying it off, um, all that. Some strategies for paying off debt. We've got debt consolidation, where say you have, 5 different loans out there for student loans and from different areas. There's actually people that can help you put that all into one to make it easier for you to organize and run off of one versus 5 different accounts at different places and different payments. Refinancing, sometimes you're able to consolidate and all these different interest rates, maybe you're able to get them lower by consolidating. And then the two strategies for pay down, the common ones are the snowball method and the avalanche method. So the snowball method is exactly what you think of when you're building a snowman. It's getting bigger and bigger. You tackle that smallest debt balance first. So say you have 4 credit cards and one's $1,000, 5,000, 10,000, 20,000. You're going to tackle that $1,000 one first. So you can check that box, put it aside, and move on to the $5,000 one. And you're going to build up that momentum, get those early wins by doing paying the small ones off. But we actually like the avalanche method better, where you're actually tackling the highest interest rate ones first. So say you've got credit cards at different interest rates, or maybe credit cards and student loan debt. You're going to pay off the balance and the debt first that has the highest interest rate, because that's costing you the most to have sit there. It's math wise, it comes out better to pay off the larger interest rate. But snowball method, another great method if you want those small wins and building up your
Yeah.
ooh, geez, emphasis. Okay, there we
Yeah,
go.
for those who are on the call, I'm sure they've heard. I mean, there's Dave Ramsey. Maybe you've seen YouTube videos with Dave Ramsey. He loves the snowball method of having some wins.
Hmm.
But as Carolyn mentioned, like on paper, the numbers work out best for you if you do the avalanche. But so just shifting gears, and I've been checking the chat. There's been no questions that we have
No.
as of right now. So why are credit scores important? So when you go to effectively get more credit, they take a look at what your report card is. It's effectively a report card. And it's going to have an impact on a house, whether it be a car, getting into their credit card. And it really can save you $1,000 over time to make sure that you have a better credit score. And the things that you want to be doing to improve this is to pay your bills on time. Don't be late. Keep your balances low. So just because you might have a limit of, say, like $30,000 on your credit card, that doesn't mean that you should use it. It looks better if you have a higher limit and you have a lower utilization, to use that word. That's something you'll see. And then only apply for the credit that you need. There's a case to be made with if you don't have a lot of credit out there, to add more does help your credit score. But what we're here to say is don't just get a million credit cards just to build up your credit score, and start early. I said this once on a call before for any of you that are on this call with parents. You can add your children onto your credit cards. You don't need to give them their own credit card. You can just add them on as an authorized user, even as young as they are, and it will help build their credit. You just got to make sure that you're doing a good job with paying off your credit card, so you can hurt or help your child. But I think everyone here would make sure that they were paying their credit cards off on time, doing things like that. But that is a way to help the credit score of your child. So with that, we'll keep rolling here.
So shifting gears to investing. Why do we invest? One of the big reasons is to beat inflation. Inflation is itching away at our purchasing power every year, and goods are getting more expensive, and that's the way the world works. And investing can actually help you stay above that increase in prices and build long-term wealth, reach financial freedom, and really let your money work for you. Power of compounding and time in the market is better than timing in the market. A great example here is to the right. Whether you've seen this chart before or not, I've seen it 1,000 times and it hits me every time. It's so powerful. So we've got Joe on the left, and Joe contributes $5,000 per year for years 1 through 10. That's it. Then he stops and he coasts and he says, I don't want to save any more money. I've got too busy with my family and life happened. I saved, those first 10 years. I feel okay about that. And he never saves more again. That $50,000 that he saved in those first 10 years grows to the 50th year to $1.7 million, assuming an 8% average return. We've got Phil on the right, where maybe he's in his early 20s and he's thinking, I'm not saving for retirement. That's so far away. I've got time to do that. I'll make more money someday. I need my money now. I want to have fun now. And he doesn't save at all in those first 10 years, unlike Joe. He starts in year 11 and he does that same 5,000 per year, but not for 10 years. He's saving it for 40 years, $5,000 a year. So he's putting in a lot more money than Joe, and he still ends up with less, $1.4 million versus Joe on the left with 1.7. So if that's not powerful, then I don't know what is. And this is just emphasizing the whole start early. Even if it's small amounts, start early, get your foot in the door, start that automation, and start getting comfortable with saving early. We've got another chart here that,
Yeah.
Andrew, you want to
And,
take
and
over?
one thing I'll say, and I don't think
Hmm.
anyone's assuming this, but it's be like both Joe and Phil. Start early and continue on for 50 years, and you
Wait,
will
you
be
cut
in.
out for 2 seconds. Be
Oh,
like
okay.
both
I said, yeah, be like Joe and Phil. Start early and
and
continue
continue.
saving.
Yeah.
And that's super important. And you can look at those two numbers and combine them effectively.
Yeah.
So the next piece we just wanted to show, because anyone here who's been on one of our participant, or we've come out to do a presentation for your company, you've probably seen that chart before. This one I wanted to show you. It's really for folks that are maybe just starting up in their career. Maybe they haven't put any money away just yet. We wanted to show this chart. So there's a lot going on here. So the assumption is that you have no money saved for retirement. Okay, so that's the first assumption. So we're going to work with that. This is saying based on your age, when you have no money set aside for retirement, what percentage you need to save in order to cover all of your current expenses at retirement. Okay, so let's look here. So if we look over on the left-hand side, we're going to go to, we'll just use the 20 at 25. All right, you landed in a job you like, you hadn't been able to save up, and you wanted to save 100% of your income for retirement. You would need to save 15% of your paycheck now all the way through to retirement at 65 to cover your full paycheck. Okay. If you waited until 35 to start saving, similar to what we talked about on that last slide, but just a different chart here. At 35, you'd have to save 30% of your income. So effectively, you can make the case it's around double you'd have to save at 35 to be able to cover your full income today at retirement. So again, if you don't take anything away from this, it's really start early, start automating, put that money away, whatever you can do, and just kind of continue and be consistent. And over time, trying to figure a way that you can continue to increase that. And that goes back to what Carolyn was mentioning about the awareness, being intentional with your cash flow. All right. So then the next piece, basics of investing. So what we're just going to talk about here is risk versus return. So I think it's really important if, let's just say you've built up your emergency fund, you have money in your 401k, let's just say you've put that in a target date fund. And just so people know, and I want to use jargon here, target date fund is you're picking a fund there's going to be a date on that fund, and that fund should typically correspond with when you plan to retire. And there is a manager out there that is managing your money to get more conservative as you get closer to that retirement date. Okay. So they are actually helping you with the risk and lowering down risk as you get closer and closer to retirement. When it comes to non 401k assets, maybe it's a brokerage account you're in or it's some sort of investment account that's non-retirement. It's really up to you. There is some investing out there, but if you're going to pick your own positions, it's really important that you understand what your risk tolerance is. Are you looking to be saving money for a home in the next 3 years? Maybe it's the next 5 years, or you're trying to buy a car. Making sure that you are taking the risk based on that timeline of when you need that money. That's time horizon. Okay. So you may want to take a lot of risk now. If you do that, you got to understand what is the risk return of that. There could be a chance that that money goes down to zero. It could cut in half. Okay. If people had gone into crypto back when the cost of Bitcoin was $100,000 a share, which has now come down to right now it's around 70,000. Back when it went down to 50, that would have cut in half. Okay. They might have had FOMO at the beginning, but now they're feeling really bad because their money cut in half. You wouldn't want to put that money in for a piece of real estate or something you're trying to buy within the next 2, 3 years. So you got to be smart with that. Diversification. It's really important that you are diversifying your money in bonds, in stocks, in alternatives if you can, which would be things like gold and silver, things like that, making sure you have that diversification. The one thing you don't want to do, there's a term out there, not many people have heard of it, but people will call it diversification. What that is that's just investing in so many different things. Maybe it's you're investing in different ETFs, exchange traded funds, where you're like, I'm going to invest in 10 of these different ones. And it turns out that those funds have NVIDIA in every single one. And you may have done well at one time and you think you're diversified, you're protected from risk, but maybe you've doubled down on something that's very risky. So it's very important to not only be diversified, but also know what you are investing in doing so. Asset allocation, making sure that to what we were talking about before, if you want to be more aggressive, you would be in more stocks, be more conservative, you'd be in more bonds, fixed income, and alternatives. So making sure you're thoughtful on that. And then volatility, understanding how you feel. And there's a lot of calculators out there to try to figure out what your capacity is for risk. There's a lot of people when the market is up, everyone wants to be taking more risk. When the market comes down, they're like, I want to go to cash. I want to get out of this market. So that's very important to understand. I've talked about stocks. Stocks are owning a company. You have a stake in that company. You have ownership rights in that company. No matter how big or small, you have ownership rights. A bond is where you are you are basically loaning your money out to a company. So even if it's any sort of company, let's just say like a Walmart or AT&T, they're going to issue debt in fixed income. You are going to give them a chunk of money. They are going to pay back an interest rate back to you. You're going to get all of your money back. Well, typically you're going to get all your money back plus the interest they're going to pay you. Okay. Then you have your mutual funds, ETFs, ETF, exchange traded fund. These are effectively basket of funds that allow you to get that diversification. And again, not to be redundant, but because you are buying into different buckets of investments doesn't mean that you are diversified across the board. You might be in one fund that's exactly the same as another fund. So it's really important that you consider that when you are picking investments. Carolyn, I don't know if you have anything to add there, but that's all I have on my side.
No, that was great. It's a lot of information, but important, good stuff. So
Okay.
moving
We
on
got
to
no
retirement.
questions as of
Yeah.
now. Okay.
Moving on to retirement planning.
Okay. So going with retirement planning, the biggest piece is we just want to outline there's a lot of moving pieces when it comes to retirement planning, but the things you want to figure out is kind of like pieces on a chessboard. Every different piece has a different move that it can make, some similar, not as similar. But the things that you want to think about is looking at it. You have a 401k, 403b, maybe you work at a nonprofit, have a 403b. There's also IRA, which is an individual retirement account that's going to be outside of an employer. There's things like HSA, which is a health savings account where you can put your money away to be used for qualified health events. And then you can also use HSA after 65 for anything that you want. And you avoid a penalty there. But for the sake of this, we'll talk about health savings account as something used for qualified health events. So within retirement accounts, there's different taxation. There's different taxation when the money comes in. There's different taxation when the money is growing over time. And then there's different taxation when the money comes out when you want to live off of that. So number one, tax deferred growth. That tax deferred growth is going to be, when we say that, we're thinking about a 401k, or maybe it's the Roth 401k. What that means is the income that is generated inside of a 401k, you do not pay tax on that money. It just goes right back in the account. There is no tax. I will compare that to a bank account, or I will compare that to maybe you have like a brokerage account or something like that at Charles Schwab or Robinhood. That is not tax deferred. The income, you would get a 1099, which is a tax form, for the income that is generated from either your high yield savings account or that brokerage account that I was talking about before. So that is not tax deferred. Then you have pre-tax contributions. What does that mean? So pre-tax contributions would be like something going into a 401k. You are not going to be paying tax when that money goes in. Your employer pays you, the money goes right in the 401k. You do not pay any taxes. Okay. Then you have Roth contributions. That is going to be that money has already been taxed. It runs through the tax system in your pay stub, and then you put that money into a Roth. And when I say into a Roth, that can be a Roth 401k, which works the same way, or a Roth IRA. All of these situations, the money's been taxed and it goes in. Okay. The biggest difference between these two, of the Roth and the traditional, is that you can either be taxed at the beginning or you'd be taxed at the end. Okay. And the key here, a lot of people think, oh, well, maybe I don't want to be taxed at the end because that balance is going to be huge. It's all about how much money goes in and how much money comes out. So it's all about how much income you want to pay yourself. Okay. So you might be in a very high tax bracket right now, and maybe you want to put that money in pre-tax in a 401k to save yourself from having to pay taxes on that money. And presumably, maybe you're going to need less money to live off in retirement than you're being paid now. So you'd want to put that money into a pre-tax 401k. On the flip side, maybe you're just starting up in your career, or maybe you're at a point with your family or your income is not as high as it normally has been. Maybe you want to put that money into Roth, let that money grow over time, and when you get to retirement, you're not going to have any taxes on that. Today, Carol and I are not here to make a recommendation on where you should be, but what we do want to recommend is that you have diversity in terms of where your money is held. And I'm going to walk through just an example here. There's a lot that's going to be going on the screen, but I want to make sure that we talk through what this looks like. If your employer does not sponsor one. So, and before we go into this, someone just had a quick question. They said, can you open an HSA if your employer does not sponsor one? As long as you are in a high deductible healthcare plan, you are able to open up an HSA even if your company doesn't sponsor. There's different companies like Optum, things like that. We have no affiliation with them. You can go to them and you can set up an HSA. I would make sure you do your research on the different HSAs out there, those third-party companies that would open that up for you. The contribution limits are no different if you do it within your company or you do it outside. So thank you for that question. So with that, we're going to talk about why diversification amongst your accounts is so important, and everyone's situation is different, but we want to walk through that here. So Carolyn, if you could just pull that up. Thank you very much. So first scenario on the left side, the most efficient strategy. Scenario 2, least efficient strategy. You get to retirement and you say, I need $100,000 to live off of. Okay. If you were to take on the left-hand side, $60,000 from a Roth IRA, or even let's just make this a Roth 401k, same thing. you would pay no taxes on that money. If you took money out of a taxable account, which would be subject to capital gains taxes, again, for this situation, for this person, they would be at 15%. And then if you took money out of a savings account, you'd pay extremely minimal tax on that as well. And what you would be looking at is you've taken out $100,000 to live off of, and the tax that you've paid is only 6,900. On the right side, which if you end up pulling from a traditional IRA rather than a Roth IRA, you take from savings and you take from the taxable account. By just doing that and taking more in the traditional IRA, you would end up having to pay tax 23,100. So you'd pay more taxes, you'd be left with less in retirement. Okay. We're not here to say that this is the perfect way to be taking out of your accounts at retirement. This is really just showing how important it is to have diversity amongst different accounts that you can pull from in retirement. And the one other thing I'll just call out here is that in some cases, we don't want to be taking out of an account that maybe the account's down, maybe the market is down. If you have diversification amongst these accounts, maybe you take from a savings account, maybe you take more from the savings account so that you can let that other account build back up. I know there's a lot going on here, but at the end of the day, all we are saying is make sure that you are diversified. Don't just put all your money in a 401k. Obviously, save in your 401k, but make sure you're diversified amongst the different savings buckets. Carolyn, do you have anything to add there?
Nope, just exactly what you said. The summary is having optionality in retirement, and these tax numbers kind of show you the different buckets and savings vehicles. And if you have money in each of them, you have options and when to pay the taxes, how much, and there's just more flexibility than if you're tunneled into mostly one. But it happens, and we see people come in all the time that have all their money in a 401k, and it is what it is. So the earlier you can start throwing in different buckets, the better. So these retirement accounts are so great, and everyone loves them so much, and they have these great tax benefits that the government has put caps on how much you can put in them each year because they're so great. Unfortunately, whereas a regular, savings account or an investment account not retirement account, you could put as much in there as you want. These retirement limits this year for your 401k, 403b, it's 24,500 if you're under the age of 50. And then if you're above 50, you get this catch up that gets you up to 32,500. Then there's relatively new in the past year or two, another catch up where they're helping people catch up to retirement savings later in life, where if you're age 60 to 63, we don't know why they cut it off, and if you're 64 or whatever, you don't get this, but 60 to 63 at year end, you're able to actually do 35,750. So it's important to look at, especially as we're, in the second half of the year, just take a look at how much you've been putting in throughout the year and if you're on target to meet these numbers. I see people all the time. I see clients come in, they say, oh, I'm putting the maximum amount into my 401k, and they set that a couple years ago. The limits go up every year, and maybe they're not hitting the limit anymore, or maybe they just turned 50 or 60 and they said, I'm, putting in the max, the 24,500. I said, well, for your age, there's more you could put in there. And they haven't checked it in a while, or they haven't done the math or looked, am I going to hit that number this year, these new numbers? Do these limits include employer contributions? The question just came in. These do not include employer contributions. So this is what you as the employee can put in. If I put in that 24,500, because I'm under 50, my employer could then stack on top of that with my match or maybe profit sharing distributions, and the limit for our combined, me and my employer, is much higher so that it allows the employer to stick money in there too, but these are just your employee contribution limits. IRAs, that's a little bit less. We've got 7,500, or if you're above 50, you can put in 8,600. This is applicable to both Roth IRAs and regular traditional pre-tax IRAs. The only catch here is you can't do 7,500 to both a Roth IRA and a traditional in the same year. It's IRAs in total. You can only put 7,500 in for the year. Roth IRAs also have a little bit stricter limits, like income wise. If you make too much money, you cannot contribute directly into a Roth IRA. HSAs, health savings accounts. If you have a high deductible, like Andrew mentioned, your high deductible health plan, either single or a family plan, then you're able to put in 4,400 or over $8,000 into your HSA. In a health savings account, you are able to roll year and year, unlike a flexible savings account where these limits would be different and you wouldn't be able to take year to year. But the health savings account, super powerful if you have a high deductible. Another question in the chat is the IRA limit pre or post tax. So this is the amount that is hitting the IRA account. So if you're talking about a traditional IRA, you're putting in pre-tax dollars. And if you put in 7,500 of pre-tax dollars, that's your limit. If you're talking about a Roth IRA, you're putting in after-tax, post-tax dollars. And that 7,500, it's what's hitting the account. It's that 7,500 of post-tax dollars. Hopefully that answers it. All right.
And then one other piece, we had that question before about the employer. I've seen it before where a company will make a match on the HSA. Unlike the 401k, the matching from the employer does count in this total number down below.
Yeah, great point.
So you want to make sure that you're aware of that. So 401k, the numbers up on the top, does not include the match from your employer. HSA, it does include the match from your employer. Hopefully you're getting a match. We don't see it that often, but just keep that in mind. The system should, we've had these questions before, the system should stop once you've hit the max. But it doesn't always do that if the 401k doesn't have the right structure. But I'm confident that if we're managing the plan, that is the case.
Yep, and go talk to your HR person if you have a match. Like we had the question earlier, if your employer doesn't offer an HSA, even if they offer an HSA, doesn't mean they're throwing any money in it. So a couple things there. We have another question on while we're here on the HSAs. Does HSA roll over between years or carry over? The HSA, the health savings account, does roll over year, and you can even take this into retirement and spend it 40 years from now in my instance. The rollover year over year, that's when you're thinking about the difference between an HSA and a flexible savings account. If you have a flexible health savings account or a dependent care savings account, there's a couple little they're all named so similarly. Those are the ones where you're putting in so much per year and you want to use it by year end. A health savings account with a high deductible health plan that we're talking about here that maybe your employer can contribute to or does, that's going to be rolled over year. You're good to take that, now till retirement. No worries there. Employer to employer. Yeah, and I do want to mention when we're talking about getting an employer match in a 401k, say they match, 4%. That's great. Always at least get that match. We always emphasize getting your employer match. It's free money. And I like to point out, try not to include that in your savings calculation. If you're trying to save 20% per year of your income, say we're targeting that 50-30-20 rule, and you're trying to save 20%, try not to include the free money from your employer. Try to do 20% of your money that you're saving, and then that can be an extra bonus, but we want to save 20% on our own. All right, let's keep going here.
Yeah, we'll keep rolling.
Other retirement considerations. We're not going to touch too much on these today. They're complicated. There's a lot to say about them. We don't have a ton of time, but other things we've got webinars on these. You're welcome to talk to us about these or your advisor. But some things to think about when you're approaching retirement and planning for retirement is when to take Social Security. So that's something that you turn on in your 60s, and there's different strategies there. Medicare, so health insurance when you're retired and over 65. There's different plans and income limits and expenses there. Long-term care and long-term care insurance. So that's caring for when you are ill and unable to take care of yourself, basically. And gifting and legacy planning, there's a lot of different strategies around gifting and leaving money to your heirs, or, business interests, and whole complexity of things there.
And I think we just have one question going back on the Roth IRA. So the question is, how does the limit work for Roth IRAs if your bonus commission may impact your total income and you committed the total amount already? That's a great question. It's actually a tricky one because unfortunately, the IRS does not care when your income all comes in, even if it is a surprise and you go over that limit. Right now, if you're a single filer, if you have income over 168,000 amongst all of your income, you're not able to make a Roth IRA contribution. So there is something, unfortunately, if this was you and you are over that, you are going to have to go back to wherever that money is held and say that you want to pull that money out. I am blanking right now of what that is technically called. It's a reverse.
Code it, or
Anyways, I'll come back to it. By the end of this, I'll get you that name. It's like a recharacterization.
Yeah.
Of that's it of the contributions where they would just have to pull those out, and then you can put that into. There's some things that you can do to do a backdoor Roth contribution, but that's something you're going to want to talk wherever that money's held. You're going to want to talk to them about that.
Do you have the limits pulled up, Andrew, for what the income limit is for
Yes,
married filing jointly?
I do. So married filing jointly, we are, bear with me.
I could find it easier than that.
We have 252,000.
250?
So yeah, 252,000.
252. Gotcha.
Hopefully people got that.
All right, let's
And
move
that's
on
between
to
the two, between a couple, between both spouses, 252,000.
combined income on your tax
Yes.
return.
All right. So we're at 1243 here, so we'll keep moving. So insurance. So it's really important that this is always not the fun part of financial planning, but it's really important that you are insuring yourself, insuring your income, insuring your family from things that could happen. And when I say that, we look at the bottom here, we have health insurance that's going to help cover you. We all know that from medical expense in the hospital. Life insurance is going to be in the event that you were to pass away, making sure that you protect the income that would have come to your family. Disability insurance is your inability to work. So you're alive, but your income may stop. Auto, homeowners, etc. That is effectively protecting your home as well as helping you from liability in the event that you get sued, or let's just say someone falls and gets hurt on your property. If they were to sue you, your liability protection within those policies actually kicks in, specifically homeowners and umbrella insurance. And then long-term care. That is for folks that are further on in their life and they're unable to do 2 out of the 6 forms of daily living, which is bathing, dressing, transferring. So basically moving from like a bed off of your bed, toileting, continence, and feeding. And so that's where long-term care would come in. That's long-term care insurance which can typically be one of the largest costs these days with people being in assisted living and the cost of that. For the sake of time, we're going to keep moving here, but if you have any questions on the insurance, please, you can, like specifically the things I just said, we can answer those questions. It's really important for you to figure out how much you do need. A lot of people I've heard from feedback that they feel like they've been sold insurance. It's really important that you are thoughtful with how much, what your current income is, what you want it to actually look like. And no one really wants to think about this, but if you were to pass away, do you want to be covering college? Do you want to be covering paying down all your debts? Do you want to pay off your mortgage? Having thoughts about that. Who would you be covering? Are there caregivers? Or if there's one spouse that isn't working, maybe they stay at home. We've seen so many times that they're not protected from insurance. They need to be protected in so many cases because that person did so much. They might not have income coming in from an employer, but they're doing so much work to take care of the family, doing whatever they're doing at home. That typically goes unlooked or unprotected. I'll keep moving here. It's important to know the time frames in which you get the coverage. It's important to know, do you want to have permanent insurance for your entire life, term insurance that covers a specific amount of time? That's when it comes to life insurance. And how can you use life insurance to protect you from estate planning, estate taxes that might come due? That's another thing to keep in mind. So we'll keep moving here. Again, if you have any questions, happy to answer it offline.
Yeah, so quickly run through the importance of estate planning. So it's protecting your assets and your loved ones, avoiding the probate process. So when you die, and if you just have a traditional will or no will at all, your assets are going to go through probate. It's a court process. It's long and timely. There's costs. It's public. And then the court is deciding a lot of things, and it's not what a lot of people would like and the ease of after their death that they want to provide for their family. So estate planning and putting some special documents in place ensures your wishes are carried out, minimize your taxes. So estate tax is a tax at your death. A lot of people won't be estate taxed at the federal level, which is $15 million, but some states have it. We're in Massachusetts, Andrew and I, and that's a $2 million. So with your home and, once you hit retirement, you've got these savings and adding in your home, everything you own, if that's over $2 million, talk to your advisor about what do I need to do to make sure I can properly protect $4 million for a married couple,
Yep.
$2 million each. And it eases the transfers of your assets at death. So making sure parts of an estate plan, your account beneficiaries, go on your 401k right now and make sure that you've got the proper beneficiaries in there. I don't want it to be an old, ex-husband or ex-wife. I don't want it to be someone who's maybe already sadly predeceased you. I don't want it to be what you don't wish. And so go check your account beneficiaries. Wills, make sure those are up to date and exactly how you wish. Same things there. Power of attorney, naming someone to make decisions on your behalf if you're unable to. Maybe you're, in a coma and you can't, or whatever happens and you can't make decisions on your behalf. Later in life, you get dementia and you're fading a little bit in the brain. Someone else can easily come in and make the decisions for you. Same with the healthcare directive, same thing, but they're making medical decisions for you. And then trust is really where we do the planning and avoiding the probate process. So talk to someone about help there, especially if you're in Massachusetts.
And maybe you have kids that are just going off to college. It's important that we've helped a lot of people with getting healthcare proxies, making sure that your kids have that, because in the event that they were to get hurt or go in the hospital at school, sometimes they will not release any medical records to you or tell you what is going on because of HIPAA protection. So making sure that you have that set up.
And also, just if your kids are under 18, the will is your primary document, the Lord and Savior, that's going to name a guardian. if you don't have a will or you don't have a guardian named and maybe you die together, you and your spouse, the court is going to decide who your kid's guardian is. And obviously, I'd rather tell the court than the court to pick for me. So the will is where you name a guardian. We have a comment here, a question here. Is it possible to designate a charity as an account beneficiary? Yeah, I don't see why not, Andrew, right?
Yeah, you can.
Yeah, absolutely.
Yeah, I do want to say in Massachusetts, if this is an interesting one, if you are married, it will go, even if you don't have your spouse on, it will go to a spouse unless they have signed off on paperwork to say that they don't want to be the beneficiary. This is on a 401k.
I was gonna say on a 401k.
On a
Yeah.
401k. On an IRA, make sure you are aware of that. Okay. That's not here to say that you shouldn't change anything. Just make sure that you have the right person on there.
Yeah, definitely check every once in a while, especially after big life events. All right, tax planning, just a couple things to mention here. So understanding a grasp of how taxes work. So there's income tax on the money that you make that can be earned, that's your salary job, that's your side gig job, and then there's unearned income, and that's your short-term capital gains, interest. When Andrew was talking about bonds that can pay you interest, that's going to land here. And those are graduated brackets where you're paying tax, filling up the 10% bracket, then you're paying tax and filling up the 12%, the 22%, and it goes up like that. Capital gains tax, that's tax when you sell an investment. The profit you're going to pay, so you paid something and now you're selling it for more, you're going to pay tax on that profit. That's a different tax rate, the capital gains tax rate, where it's flat and it doesn't go through the 10, 12, 22, 24. It's just 0, 15, or 20% flat tax. Estate tax, I mentioned that before. When you die, you may, depending on your wealth, owe an estate tax. If you, as a couple or as an individual, own and your net worth is more than $2 million in Massachusetts, please bring that up with someone so you're properly planning to avoid estate taxes the best you can. Deductions versus credits. So deductions are lowering your income, and then you calculate the taxes off of it, where credits, you calculate your taxes and then you get, a coupon for X amount off your taxes. A little bit different there. Strategies to reduce your taxes, using those pre-tax contributions to retirement accounts that'll reduce your income, claiming all those deductions and credits you can get. Hopefully you're working with an accountant that can, point out which ones you may qualify for. Tax loss harvesting, a little more complicated to do on your own for investing, but that's an investing technique. Charitable donations, you can get deductions for donating to charities, and that's another a little more complicated question for your accountant. All right, running through that.
There we go. All right. Well, this is our final slide here. At the end of the day, what we want you to take away is that I know there's a lot going on. Listen to the recording. This will be sent out after. Make sure that you just try to start somewhere, try to get organized. And then all these areas work all together. It's so important that you're thinking about all of these things, and don't be afraid to just start. I will say in general that there's a lot of information out there and you can put into AI. We are not against AI by any means, making sure that if you are putting things like cash flow and stuff like that into AI, making sure that you are stripping it from any identification that it's you. But that is a good place that you can start to try to just get yourself organized and try to learn more. If we can be a resource by any means, please let us know. We're happy to help. And yeah, you are not alone. And so thank you very much for joining us here today. Please come to our next webinar in September. And anyone has any question or anything, these are our emails here. Happy to help however we can.
Thanks, Andrew.
Thank you, Carolyn. Have a great rest of your day, everyone.
Bye, everyone.